The news report that we have seen on the from the Fitch ratings on Sri Lankan banks, Sri Lankan commercial banks, which they say because of its exposure to the high sovereign risk. Well, that means the Sri Lankan commercial banks, according to this Fitch ratings report, the Sri Lanka's large commercial banks have, have more heightened sovereign, risk because of their high exposure to foreign currency denominated Sri Lanka government development bonds, and also because of the weaker capital positions. That means the what the Fitch ratings, their argument is since Sri Lankan commercial banks have invested most of their foreign assets in terms of dollars. Now the Sri Lankan commercial banks have their US dollars, euro, Japanese yen, renminbi, Indian rupees, etc., in foreign banks abroad, overseas in different countries. For example, a Sri Lankan commercial bank like Hatter National Bank would have their US dollar current account in a US bank like Bankers Trust Corporation, or Ceylon Bank can have the sterling pound account in the name of Ceylon Bank account at Barclays Bank, United Kingdom. So similarly, Sri Lankan banks have invested their foreign currencies to buy Central Bank of Sri Lanka's issued Sri Lanka development bonds in US dollars. So now, what the Fitch rating says is, and also like because of these situations, according to Fitch ratings report, there's a lot of sovereign stress on the Sri Lankan. This situation. Now, what is sovereign stress? Sovereign stress is actually the faced by the large Sri Lankan banks. Now, sovereign stress is like a not receiving the expected yield from a bond, normal bond compared to a benchmark bond. Now, because of the sovereign foreign risk, debt risk to the Sri Lankan government, where Sri Lanka is undergoing foreign reserve pressure because its foreign reserves are the country's total foreign currency abroad as calculated by the Sri Lanka Central Bank. It's around a little bit below US dollars 4 billion. So when the foreign reserves have declined considerably due to the political pressures and also due to the pandemic driven situations which resulted in the exports declining, and also because of the IMF, mainly because IMF not keeping its obligations to support a bailout package. Under these circumstances, when the foreign reserves are declining, how would the Sri Lanka government central bank would honor its yield payments to the Sri Lanka development bonds? That means its due interest payments to the Sri Lanka development bonds is questionable, because without the foreign reserves, it cannot pay the yield payments on a expected yield payments of the Sri Lanka development bonds can decline because compared to a benchmark standard normal bond issued by any other country. So, in this situation, that is known as sovereign stress, because of the decline in the foreign reserves due to IMF and World Bank and pandemic-driven export declining, and also because of that and the large component of foreign debt of the country. But anyway, Sri Lanka is supposed to in July to make US dollars 1 billion payment for sovereign bonds payments. So I think that has driven the stock indices high up yesterday. But now the which report says that because of the sovereign stress on Sri Lankan commercial banks, and its high exposure, where the Sri Lankan commercial banks have invested a lot of money of its own foreign assets on the buying Sri Lanka development bonds issued by the central bank. Now, because of this large direct exposure to the sovereign, largely via the government Sri Lanka development bonds by the Sri Lanka's commercial banks, and also its limited, access to the domestic economy, where the Sri Lankan commercial banks are not like authorized by the central bank to, borrow and deal with, U.S. foreign commercial capital, U.S. foreign exchange markets or European markets, where our commercial banks, lending and borrowing, mostly we borrow sometimes from overseas banks, but our lending is restricted. Sri Lankan commercial banks are prevented from lending in US dollars to foreign exchange markets in US or UK or Europe or Japan or China. Because if they lend, that is Sri Lankan Sri Lankan commercial banks foreign currencies that they would be lending. So in case of a problem in overseas markets, the Sri Lankan commercial bank would be unable to receive the amounts that they lend overseas. Because of that, there are set restrictions by the central bank when it comes to foreign lending for Sri Lankan commercial banks. So this is the one reason why Sri Lanka was not affected due to the 2006 US mortgage bond driven recession or the Asian financial crisis, which resulted in a crash in the Asian nations, did not affect Sri Lankan commercial banks, because Sri Lanka's central bank regulations prevent Sri Lankan banks from lending overseas. Because in case of lending overseas, as happened to the the British, European and the British banks, because of the crisis in 2006 driven by the mortgage bond crisis, and when the US commercial banks couldn't recover their payments, and ultimately they defaulted payments to the European and UK banks. And as a result, that's because the US Federal Reserve System allows US banks to lend overseas to UK and borrow from UK and Europe. But so because of that, the European countries and the UK countries also got affected because of the US recession due to the mortgage bond defaults. So to avoid a similar situation in Sri Lanka, the central bank prohibits Sri Lankan commercial banks from either lending significantly or lending at all to foreign assets, so foreign nations. So because of this situation, the Fitch rating says Sri Lanka's commercial banks are directly more domestic Sri Lanka centric operations, and due to also because of the local and also its commitment is only to the local financial markets and Sri Lanka centric operations. So because of that, they say they have a direct exposure to the and also to the Sri Lanka development bonds. Sri Lanka commercial banks have invested. As a result, the Fitch rating argument is because of that, the Sri Lanka commercial banks are unable to borrow significantly, since it doesn't have lending overseas also from the international operations. Rather, its operations are limited to Sri Lankan economy and the Sri Lanka centric domestic economy by the central bank regulations. Sri Lanka commercial banks are more facing a heightened sovereign risk, higher credit exposure risk in a credit exposure because of this situation. So let me continue from the next video.